Good morning and welcome to Bazaar Ki Baat. August was a rather interesting month. While we saw Nifty 50 correct 2.5%, mid and small caps continued to soar. Note that this is in contrast to what we saw in 2022, where Nifty 50 ended the year in green, but small and mid caps ended in red. Good morning, Kshitij. Welcome to Bazaar Ki Baat. What do you think is happening in the markets and what's your view on the overall markets?
Yeah, so I think largely, as you said, the large caps are taking a breather after 5 continuous months of uptake, and on the other hand, mid and small caps are roaring, and they have had last few months have been they've gone absolutely bonkers. Uh, Largely on account, I would say the rally in large cap has largely been account of 6 straight months of inflows from FII in Indian markets. Indian markets have stood out in August as foreign investors sold stocks in almost every other Asian markets in August. So Asian and emerging markets, global funds purchased close to, I think, $1.6 billion of Indian shares as of August 30th. So while the overall gain of 6.3 or 7%, close to that, in the Indian benchmark, trails its peers in Taiwan, South Korea, our own country actually is one of the most consistent performers in the region. Just to put in perspective, we are having the eighth annual. We are in line to have eighth annual advance for our large cap indices. So 8 continuous years of positive returns from our equity markets,
But if I remember
which has been.
correctly, yeah, okay, okay. But if I remember correctly, Kshitij, we saw an FII outflow in January and February. So what turned the tide for us, and why is there a sudden bout of interest from FIIs in the Indian market?
Yeah, so I think for Indian market, I think one of the biggest advantages is that they offer a diversified opportunities, and it is been among the most large fast growing economy. I think it is one of the large fastest growing economy, and this is in contrast with the rest of the world. In Europe is slowing down, US is slowing down, and many parts of Asia, many countries which are completely export focused, are slowing down because they are dependent on Europe and US for their exports. And which when the end user market is slowing down, those countries are also facing the brunt. While I believe the benchmark indices, now that the FII flows have slightly started to slow down, may enter into a consolidation mode in going forward after a sharp uptick in the last 5 months. But with corporate commentary being strong all across, I think across industries, apart from maybe one or two IT and others, and with a strong result season, which we had last quarter, I don't expect a very large or deep correction. More so, I think we will probably have a more phase of consolidation, and where the valuations, just to put things in perspective, a quarter of time correction would result in a valuation correction of 4%, because of what we are seeing, a strong earnings growth expected, and that should suffice to make our equities competitive going forward.
All right. Yeah, I think what you're saying is also evident, when we're looking at the sectoral performances, most of the sectors have been doing well. What's your view on sectoral performance?
Yeah, I think, see, if we take as the calendar year, industrials, capital goods, auto, realty are doing well, while the IT has struggled largely. The IT sector has struggled largely on account of slowdown in earnings, and because it's an export-oriented sector. While the domestic focus sectors like these industrials, capital goods, and auto and reality, and domestic focus and capex-oriented, which are being supported by the PLI schemes of Make in India, are making a comeback. This is also an indication that the capex cycle is turning in India. So far, majority of the capex has been done by the government to crowd in private investments. We are seeing green shoots now with several of the companies in auto infrastructure, reality, pharma, chemicals, either talking about doing capex or are in midst of their capex cycle. So this consists also just another indicator which points out towards this turn is that we are seeing consistent growth in advances from the banking sector to the industries, which also indicates that there may be investment cycle coming in. I believe that going forward, manufacturing and related sectors can continue to perform well.
That's very interesting. I think we have been talking about capex spending for a few months in our Bazaar Ki Baat videos, and I think that's clearly now showing in the market price performance. Uh, we are just around the close of the first quarter earnings, Kshitij, and corporate earnings in India have been doing well for the last few quarters. However, if I look at the top line growth for the June quarter this year, we see a very modest 5% kind of a growth. So, is this some kind of a slowdown in top line kind of an indicator, or should we read it differently?
So I would attribute it not so much as a slowdown, but to the base effect of the previous year's June quarter, where we had a sharp uptake. Not, but on the other hand, the profitability, if you look at the profitability number, there we have witnessed a sharp spike, and we have recorded a highest yearly growth of YOY growth of 33% in almost across last 6 quarters or 7 quarters. Largely, this has been because there has been some decline in input cost after there has been, I would say, because we had seen a sharp spike in input costs last year due to the Russia-Ukraine conflict, which has kind of now the input costs have started to come down, and which has resulted in a sharp expansion of margins. However, I believe going forward, these input prices stabilizing, uh, we are dependent on top line growth for earnings to continue. So that we have to continue to track. If is it it's only a 1 quarter phenomena, or the growth is really slowing down. But I think the corporate commentary is all around. I think we are probably going to see continuation of growth.
Right, right. But do you see this growth is sector agnostic, or is it pocketed in a few sectors? So we were looking at this data across sectors, and what do you think is happening to top line and bottom line growth across sectors here?
So we do see divergence across sectors. If you can see the chart, I think we will get a fair idea that how much sharply divergent all the sectors are in the last quarter. Most of the earnings, I would say the bulk part of the earnings came from oil and gas and banking. Uh, though the percentage might not look very high for banking, but because the banking sector is such a huge part of our at a market cap level, it contributes to our overall earnings a lot more. If just to point out, as we have already talked, infrastructure is also making a comeback thanks to the cooling of raw material prices, and which indicates that there is an increase in economic activities in India, and this may bring in more investments into the sector ahead. Oil and gas, IT, obviously, this month might have done well, but overall, I think IT had the has been having the most sluggish
Hmm.
quarters.
Right. So you mentioned, banks being such a huge part of our, in market capitalization terms, it's been
Yeah,
such a
yeah.
huge part of our index as well. What's happening in the banking sector? We've seen banking, doing well for a few months and even quarters now. So what do you think is really happening there?
No, so the banking has had a stellar run, I would say, probably for last 2 to 3 years. And I think, but this quarter was a mixed bag. we had healthy loan growth, sustained improvement in asset quality, but the margins have taken a beating more than expected. So there was some expectation of margins declining, but I think the margins have taken a beating more than expected, largely on rise of the sharp funding costs. So there was I would say, a run for deposits, and the deposits cost suddenly increased for banks. Liquidity also tightened, and overall, I think the banking sector is in a good place from because of the continued credit expansion, with retail and MSME sectors doing well. We should continue to see growth in banking, but the margin trajectory has reversed, so that needs to be watched out. So
Hmm.
some of these names
Right.
are quite overvalued or expensive at times. So that may reverse going forward.
Right. And what about automobile? We have seen a few upgrades over there as well. Do you think that there is a pattern playing in the automobile sector?
Yeah, I think the automobile sector benefits from better gross margin and thus aiding overall profitability. Commentaries related to sequential improvement in exports. So exports were really dragging for two-wheelers specifically for I think last 2 3 years. There we are seeing some amount of uptake, and two-wheelers had a I would say a very good quarter last time. Automobiles overall, I think, have been yielding good results. Automobile, all said and done, is a cyclical sector. So now that we are seeing demand uptick, it is doing very well. We are seeing new product launches, richer product
Hmm.
mix, and price hikes. So that is all this put together has helped the automobile sector. Now that we have a festive season in offering in the coming few months, we might see even continuation of this strong growth from the automobile sector.
Right, right. But tell me, Shiddat, what's happening on the FMCG sector? I mean, ever since we have heard that FMCG is a defensive sector, so what is FMCG struggling about?
FMCG, I think, is largely struggling from with revenue growth, and that is also so they might have seen revenue growth, but that has largely been due to the price hikes. So the volume growth is not there, I would say, and a large part of it is due to rural stress. We have not seen a rural recovery post-COVID. So we have 2 3 years of continuous our rural dragging behind the overall growth as compared to the urban sectors. We have seen a sharp urban growth while the rural growth has struggled. I would say, but if we talk about consumption overall, I think luxury consumption as a space is doing well. Hotels, malls, luxury retail, etc. are doing well. But the staples in the FMCG are not doing so well.
Hmm.
So that has been, I think, the wide contrast in consumption. We are seeing two sets of so that indicates that urban rural divide.
Yeah, yeah. Makes sense. Okay. Thank you so much, Shitej, for your insights. I
Thank
think
you.
India is pretty strongly placed, but we need to watch out for the next few quarters in terms of whether we see any time correction and consolidation in the Indian markets, and how do corporate earnings really fare in the next few quarters. The next topic that we have for discussion is just understanding a very simple thumb rule in the world of investing, which is called the rule of 72. While this concept is extremely simple, I personally feel that the applications of this principle in our lives of investing is very, very limited. Why do I say this? So normally when I talk to people, I hear it very often that, somebody's saying that, what, I bought this flat for 80 lakhs and it's worth 2.5 crores today. So while that sounds extremely rosy and good and a very, very good deal, the point that we completely ignore is that it became 2.5 crores over what tenure of time, right? So we completely miss out the factor of time, and that is what rule of 72 brings into play. A very good morning to you, Vikas. I would like to invite you to explain what rule of 72 really is, and how do you advise your clients to apply this in their lives of investing?
Hi, Shruti. So the rule of 72, actually, I came across this rule maybe 10 years back. And I have felt that this is a very simple rule, but has very, very huge implications whenever I do any kind of investment decisions or even small kind of decisions which I have to take in my day-to-day life. So this has immensely helped me take rational decisions. And within split second, you come to a conclusion. So this is a very, very simple rule, but I think it has a lot of applications in any kind of decisions that you're taking. So it's a very simple rule which says that if you divide 72 by whatever rate of return that you are getting, you will know how many years it will take to double your money. So it can inversely also be used when you know that your capital has doubled or it has gone 5x over what period of time, and then you can actually derive what is the rate of return that you have generated from that kind of investment. So it is a very simple rule, but it can be used at a lot of places. So I like to discuss how the application of the rule happens. So see, what happens is that this, as we have come like a lot of times we discussed about compounding, and the results of compounding are back-ended. So whenever when like let's first discuss the simple rules. So if you say suppose you are generating 8% returns from your FD, we should know that what is the number of years that it will take to double my capital. So if you divide the FD return of 8% by 72, you know that now 9 years will be required to double your capital. Whenever the rate of return increases, the number of years to double your capital goes down significantly. So this rule helps you decode how can you compound your capital at what rates and at various periods of time.
Right, and I
So
think you are mentioning 8% here, but I think what we need to call out for also is that this 8% we also pay taxes on that. So is using a post-tax return better when we use this rule of 72?
yeah, so see, if you actually 8%, like you have rightly pointed out, there are some people who may be paying lower tax, who may pay some may be in 30% tax bracket, some may be in 20% tax bracket. So always a better way of calculating your doubling of your money is post-tax returns, but it will be very, very individual specific. So today we will try to ignore taxes so that we know that how things shape up for like a normal individual who's not taking taxes. But as you correctly said, it is always better to understand what is your post tax return, and then you calculate your like number of years that you will take to double your money. So like we have taken a small example. What we have tried to say is that if you have 10 lakh rupees and if your FD is generating say 7% return, again no tax is considered. And if say suppose you have an equity MF or you have invested in direct stocks, and if you're able to generate 15% returns from your investments. So the point we are trying to make aware with rule of 72, you can understand a lot of things about investing. So an FD will take 10 years to double your money, because how do we calculate is we divide 72 by 7, which says that 10. So you will take 10 years to double your money. But if you take, and these are approximate numbers. So with rule of 72, you need not be absolutely right, but it will give you the directional picture of your investments. But if you have equity, which is generating 15 years, 15% return, you will take only 5 years to double your money. Now what we see is, say suppose we take an example of 10 years. Say suppose we did these two investments. Somebody had 20 lakhs. He invested 10 lakhs in an FD and 10 lakhs in a mutual fund. So what happens that after 10 years, your FD will only double once, because when you divide 72 by 7, you get one double on your FD. But when you divide it 15 by 72, your equity will get two doubles. So your 10 lakh will become 20 lakh in a FD, but in an equity, it will get two double. So 10 into 2 is 20, 20 into 2 is 40. So now what happens is that this higher compounding for the initial 10 years, we are still seeing it's a marginal difference. 20 lakh is a big figure, but still it's not something which is stark. But when we go this to 30 years, why we always say that you have to plan for your retirement early, why we say that investing in equity creates a lot of difference in your wealth, this can again be understood with this rule of 72. Now, when we move to 30 years, let's do the calculation through our own like mind only. We don't need any calculators for this. When we divide 72 by 7, we know that we take 10 years to double our money. We get how many doubles? Shruti, you tell me. How many doubles do we get from
Three doubles.
three doubles? So 10
Yeah.
becomes 20, 20 becomes 40, and 40 becomes 80. Now, if we divide 75 by 15, we know that we double every 5 years. How many doubles do we get? Six doubles. So it is 2 to the power 6. So when we do 2 to the power 6, we get like 640 lakhs. So we double our money. So that now the difference is close to 5 crores and you are actually generating 80-85% more returns on your investment. So now this rule of 72 is very helpful. Yesterday, I was having a discussion with my father. So he was reading an article and he was saying that I had invested in gold in the year 2008 and I had invested at 12,000 rupees. Today it is like 60,000. So I have made like so much of money. It is like 5x. So I was reading this chart which was published by Stable Investors. So this also gives you some nice insights that if you have doubled, if you have made 5x, like what my father was saying, 5x in say 15 years, the returns are 11.3%. So it is not a return, it is a very good return, given that you have invested in a very good asset class, but you have not generated a return which is like 20-25%. It is a good compounding return, but you should know that what has been your actual CAGR. This helps you make more rational decisions. So if, and one more thing, what we need to understand with this is that if you are compounding your capital at anywhere like at higher rates, which is above 20, we see that how it affects over the long term. So if you see 15 years and a return of 20% makes your capital 15x. So slightly higher returns and slightly longer period has a very big implication on your compounding. So I think everybody should use this rule of 72 is my view, can help you make some rational decisions with split seconds.
Right. And I think the applicability of rule of 72 is very relevant because this can be applied across asset classes, right? So you just mentioned how your father was thinking about gold. Similarly, a lot of people, India is very fond of investing in real estate. So this is a very good way to evaluate your real estate investments. Of course, in financial markets, we use this terminology very, very often, but I think we don't use it that much in other real estates, which have been traditional real estates as asset classes as well. So I think that's a very interesting insight and very, very relevant for investors who are looking to start investing early as well. Thank you so much, Vikas, for this topic and your insights. To our viewers, thank you so much for taking out time. Stay tuned for our next episode and have a good day.